The Consumer Price Index, or CPI report, came out on Tuesday, the measurement of inflation, and it really rocked investor confidence. So what does that do to mortgage interest rates throughout the course of this week? Let's go ahead and let's dive into that information and get into it right after this. Well, welcome back after the break, everybody. Mike Petras here, your Star Realtor of Star and the Treasure Valley, back again with another weekly mortgage update for the week of the 12th through the 16th. Now, of course, as I said in the intro, the Consumer Price Index, or basically the inflation report, came out, and year over year, signs were looking pretty good when it came down to the CPI itself. But the core CPI of what the Fed looks at actually went up, and month over month, the inflation actually went up too. So did the Fed actually capably handle their inflation rate from the rate rises they've been doing to the federal funds index over these last months? Unfortunately, no. So we are going to see the Fed get a little bit more aggressive, but how aggressive and what is going to happen to mortgage interest rates and what is really kind of happening in the stock market as compared maybe to the bond market here too. So let's go ahead, let's dive into that information and find out. So let's go ahead and let's dive into the data, everybody, and take a look and see what happened this week. And really the focus of this week is going to be on the CPI report, or the Consumer Price Index, basically our inflation report. Even though the Fed looks at the PCE reports a little bit more than the CPI per se, and they look at the core CPI of the Consumer Price Index, still the numbers were not looking good. And I want to go ahead and start off with this. It did come out Tuesday at 8:30 a.m. And we can see that the Consumer Price Index actually for year over year came down. It came down from 8.5% of what we were at last year to 8.3%. But the month over month was where the problem was. The month over month said that inflation still wasn't handled. The numbers rose. And then, of course, as I mentioned, they look at the core CPI more than they do the other report. And if we take a look at the year over year on the core CPI, we were at 5.9% the month before. And now, boom, we're at 6.3%. So has the Fed done what it took to in order to handle inflation? The answer to that question is no. So what that means is that the Fed is going to use their really big weapon that they got, which is the federal funds rate, and they have to get more aggressive with it in order to tame inflation. Now, the federal funds rate more or less affects short-term bonds as compared to like a 10-year treasury, which is considered a little bit more of a long-term bond. And we do know that we are inverted from, say, like a 1 year to 2 year all the way to a 10-year, is that you can actually get more return on a yield in a 2-year right now than you can a 10. So why would investors want to invest in a 10-year yield as compared to a 2-year yield? They wouldn't. And so that's where the Fed comes in and kind of puts on the brakes. Now, the other thing I just want to clarify too is that even though the 10-year treasury yield, doesn't really get as rocked by the FFR or the federal funds rate increases as much as, say, like the 2-year treasury yield does, or short-term gains, it still gives a lot, it still can ripple down to the 10-year treasury yield and make people nervous in terms of what's going on. So right now, we've actually seen even the stock markets, ever since the CPI report came out, take some of the biggest hits that we haven't seen since the pandemic started, and even sometimes beforehand. And if you're monitoring the markets, or you got, say, you're in your retirement and 401ks, etc., you've probably already seen what happened this week. It just really hit. And usually what happens is when people start feeling the pressure in the stock markets, they usually run to the bond market because it's more secure. But in this case, both the bond market and the stock market took hits based upon this, because everybody knows that the Fed has to get more aggressive. So they are meeting next week. They're meeting on Wednesday of next week. Powell will speak. Powell will give the thoughts of what the Fed wants to do. So there was discussion about them going up a half a point or 0.5%. Then there was discussion of them going up 0.75%. But now there's discussion from a lot of economists out there of whether or not they have to go to a full point. So 1 whole point in order to start combating this inflation. Because honestly, they got to it too late. And as I see this, as it goes along, and this is the good news for buyers, sellers, investors, is that I don't see that soft landing that they've been trying to go after gonna happen anymore. I honestly see effects of a recession coming up. And when a recession hits, we know historically rates go back down. So just know that. And I think that they can come as early as after the midterms to maybe even a quarter two of next year. We should wait and see. But if I was a betting man, that's what I'd have my bets on, is so that we can kind of see that relief come through. But they are going to, again, recap, get more aggressive. We're just going to have to wait and see how aggressive they're going to get next week. And it's just going to put more pressure on the United States economy, and it's going to slow it down even further. So get ready for that. So let's go ahead and let's dive into the data here, and let's take a look at what's happening today in the 30-year MBS at a 4.5 coupon. We can see that it's gone down 0.02 of a basis point to 97.77. And it's really, the values have been dipping all week. Really ever since they heard the CPI report come out. They're like, oh my gosh, and people are selling off their stuff. And of course, we know that when this value it goes down, we know that the mortgage interest rates go up, and then vice versa. When that goes up in the value, we know that the mortgage interest rates come down. And unfortunately, the news is that today we are sitting at 6.35%. For a 30-year fixed mortgage, which actually now superseded the mortgage at 6.28%, the highest that we saw since that was established in June of 2022. So now we're above that last height. But don't panic. Please see the end of this video, buyers. If you're in the market, it still is a good time, and this could work to your advantage. So please check out the end of this video to see my thoughts. But I want to go ahead and just kind of show you what was going on. So on the 12th, we did take a dip. On the 13th, took another dip. We got a little bit of relief there, just 200ths of a point on the 14th. But again, just been kind of doing that downward slide. They did put themselves in pretty good defensive positions over the last couple of weeks, if you do watch these videos consistently. And what I kind of figured, of seeing this maybe go down a little bit harder, really hasn't, but it's still put us above our peak that we hit back in June. So if we're looking at the 15-year UMBS, good news today. It went up 0.13 basis points, and it's sitting at 100 on the dot, today. And so that's good, because we know when the value goes up, interest rates will go down on a 15-year mortgage in the UMBS. And if we're looking at the 4.5, we can see that now remember, UMBS is kind of considered more of a short-term deal, like say like a 10-year treasury yield. So it can have a little bit more ripple effect from the FFR, even though it's kind of separate. But either way, we saw on Monday, on the 12th, it slipped down 11 basis points. On the 13th, when the CPI report came out, because the 15 years more of a short-term, boom, took a hit at 0.44 basis points. Got a little bit of relief on the 14th when it went up 14 basis points, which relieved it. But on the 15th, also hit another 64 basis points on the downward direction, which is raising up those rates. Okay, and today we got some relief, as we say, from there at 13 basis points. So let's go ahead and let's take a look overall where we're sitting here. Of course, for a 30-year fix, we're sitting at 6.35%, which is up 0.02% today, but over the week up 0.38%, and then over the month we're now up a full point from where we are from the month ago. If we're looking at the 15-year fix, we're looking at 5.65%. Today it went up 10 basis points, or 0.10%. For the week, went up 0.39%, and then the month up a point as well. 30-year FHA sitting at 5.75%. Up 0.15% today. Over the week, up 0.37%, and over the month, up another point and some little bit of change. 30-year jumbo sitting at 5.70, up 0.05%. Over the week, 0.40%, and then over the month, up another point. The 5-1 ARM sitting at 6.12, up 0.12%. Over the week, up 0.17, and over the month, up 0.57. And then the 30-year VA is sitting at 0.2%, up today, 0.43 over the week, and sitting at 1.1% over the month. All right, so let's go ahead and quickly dive into the treasuries too as well. And if we are looking at the 10-year treasury note, we know today that the yields went down a little bit because the price of the bond went up. So again, it's got the same inversion. If the price of the bond is going up, we can expect the yield to come down a tick, which in this case that it did. And really the mortgage-backed security game, closely relates to the 10-year treasury yield, even though it's technically separate. But that's good news, for us today, and hence why we're kind of seeing, some of these trickle down, a little bit. But as those yields eventually come down when the prices go up, that's a good thing for us. But right now, when the federal funds rate is going to increase next week, we generally see the bond price fall, which is going to probably raise the yields and maybe the mortgage interest rates with them. So we're just going to have to wait and see. But that's something to maybe consider and bear down for. And we'll just have to see what happens next Wednesday. So please stay tuned and see what happens next week with our mortgage interest rates. But the good news is the yields fell a little bit. Prices went up on the 10-year treasury note. If we look at the 2-year treasury, we can see the same thing. Prices went up a little bit today, and we can actually see that the yields came down overall. So that's what we kind of got going on. But again, the federal funds rate does really kind of affect the bond price. If they're going to go up, you can expect the bond price to go down, yields to go up, and mortgage interest rates to generally follow it. So can I see that, our rates kind of going up a little bit further? Yeah, I kind of do, but we'll just have to wait and see. All right, but here's what I want to talk about is really just kind of what happened, over the Dow Jones and the NASDAQ and the S&P since Tuesday's report. If we're looking at September 13th, when it came out, bam, I mean, it just took some hits. And the good news, generally, even though bonds and even though for today, bond prices went up a little bit, because usually what happens is that when people really start losing in the stock markets, they generally run to the bonds. And that's what we kind of want, because if the bond price goes up, we can see the yields come down and we can see mortgage interest rates possibly fall. So we'll just have to wait and see. But this week, both the bond market and the stock markets took significant hits, and significant hits that we just have not seen since the pandemic or pre. So again, over the entire week there, the Dow Jones is down 1,500 points and some change, or 1,500, points and some change. That's a big, big go. And it's sitting at down 4.79% over the past 5 days. If we're looking at the NASDAQ, went down 201.62% today, or points today, which over the week sitting at 2420, 6.77% down. And even the S&P down another 56 points today. And if we're looking over the week, down 5.85%. We're just going to have to continue and see what's going on. But when the Fed funds report comes out, or they actually say, how many points they want to go up, if they go up a full point, we can actually expect this to probably get worse. If they go up 0.75, which is I think what everybody's expecting, we'll just have to wait and see. But that might soften the blow a little bit in terms of the bad news that we're probably going to see come next Wednesday. So we'll have to wait and see, everybody. And let's go ahead and let's finish up this video. Well, thank you very much, everybody, for taking the time out of your day to watch that video. I do hope that you found the information useful, but I just kind of want to go ahead and reiterate, we do know that the mortgage interest rates are going up, and because of the reasons that we said during the data portion of this video. But does that mean it's a bad time to buy? And the answer to that question is no. So, and here's the reasoning I've got behind it, buyers. And again, like I've said in other videos, this is not any realtor tricks. It's to kind of putting things in perspective. So what we do have right now is a softened buyer's market, which meant that we've got more inventory on. So what does that mean? That means that the days of fighting for a property like a year and a half ago are completely over. And it means that you can actually go out and find the home of your dreams. What is also happening with these properties is that price reductions are happening at really record levels. So that means that you can get the house at a discounted rate, and we know the values have been coming down in Ada and Canyon County in terms of the overall median price. So not only you're getting a price reduction, but on top of that, we could probably still negotiate for even lower prices, or, and most importantly, a lot of these sellers are bringing back concessions. So what are concessions? Concessions are, i.e., picking up your closing costs, or maybe giving you a concession to be able to buy down your rate. So there's opportunities out there. This is a buyer's market and a good opportunity to do so. So with the mortgage interest rate on the high end like it is, will you feel the pinch for a bit? Yes, you will. But the good thing and the good news is that the Fed really does not seem to be able to have what it takes to be able to come in with the soft landing that they were talking about. In my opinion, if you're asking me personally, and maybe a lot of the other economists out there, are the effects of a recession inevitable? And yes, I see that coming through, maybe after the midterm elections, all the way maybe into Q2 of next year. So when the recession hits, we know that historically rates come back down. So you can refi when they do come back down for almost free to nothing. So really it is a win-win situation overall, instead of, wow, this interest rate is really high. Yes, will you have to kind of deal with it for a little bit until those rates come back down? Yes, but they are going to. This recession, in my opinion, is inevitable. Talk to people, and please comment below if you want to add to this conversation, or maybe you disagree with me. Love to hear what you've got to say. So please comment below. But thanks again very much for watching this video. And of course, if you are looking to buy, sell, or invest right here in the Treasure Valley, please feel free to reach out to me. You can reach me at 208-715-STAR. Again, that's 208-715-7827. And if you're looking to begin your home shopping experience today, please visit my website at www.yourstarrealtor.com. Also, if you're looking to move in from out of state, please click in the description below, download my free relocation guide, so that way you're in the know before you decide to make the move. Also, please hit that subscribe button below, click on the notification bell so that you're constantly in tune with all the videos that I do come up with. Well, thank you again very much, everybody. I look forward to the day that we speak. I look forward to the day I call you my neighbor. God bless. Until then, thank you so much. Bye-bye.